and welcome to this month's Financial Markets Update. Well, may prove to be the reversal of what we saw in April. Financial markets were by and large a lot more weaker throughout the course of May. We only saw really positive performance coming out of unhedged global equities and emerging markets, and that was really driven off the back of a weakness in the Aussie dollar, which was down roughly around about 2%, as well as some stock-specific factors that we saw throughout May in the US, principally the significant uptick that we saw in Nvidia in regards to its announcements to the market throughout the course of May. But when looking at the local market, we did see significant weakness both in large cap as well as small to mid cap equities, and a lot of that was driven by the weakness that we saw in the commodity parts of the market. The material sector was down roughly around about 4.5% locally. We saw broad-based industrial commodities also lower: copper, nickel, aluminium, while oil was also lower on the back of what is a weakening of the global economic outlook, and that saw the RBA commodity index down roughly around about 6.5% to 7% over the course of the month. That translated into our local market performance, and as I said, we saw some weakness right across the board on the back of that. Equally, over the course of the month, we saw central banks continuing their rate rising program, and so the RBA actually increased cash rates by a further 0.25% to 4.1%. Certainly unanticipated by the market. We did think that the RBA could probably wait 1 month, but just given the nature of inflationary expectations here domestically, with inflation still well north of 6.5% here locally, the RBA certainly thought it was prudent to increase cash rates by a further 0.25%. But I think what's more interesting in the context of what we saw was also the commentary by the RBA, and they, in our view, certainly are pointing to cash rates continuing to move higher here domestically throughout the second half of this year, and we expect potentially another 2 further rate rises here domestically, as well as a likelihood of further rate rises in global markets. We did see the Fed actually increase rates along with the ECB and the Bank of England, so we have seen a coordinated approach of higher rates continuing to come through the system more broadly. And to highlight this point, if we were just looking at our forecast implied cash rates, you can see here the chart showing both the US and Australia. You can see that the forward rates are pushing higher, and certainly when we're comparing that to earlier part of the year, materially higher in the context of the Australian landscape. So upwards of roughly 0.5 to 0.75% higher relative to what cash rates expectations were throughout the first quarter of this calendar year. So significantly, this is having pressure on financial markets, and we did see quite a significant sell-off in bond markets, certainly at the back end of the curve, and bond yields right across the board in global markets increased over the month, and this obviously further put further pressure on both equity, bond markets and other interest rate sensitive sectors over the course of the month. So really quite a challenging environment, with a backdrop that interest rates are likely to move higher, and we haven't yet seen, certainly locally, a significant decline in inflationary expectations, or certainly a decline to the extent that the RBA is comfortable with in regards to holding off increasing cash rates. As we move forward, we do expect that the US Fed will, at least through the course of June, certainly, as I said, keep cash rates on hold, but we do expect further cash rate tightening throughout the second half of this year. So when thinking about that in the context of household savings and the ability of consumers to be able to withstand, as I said, higher cash rates, higher inflation coming through in goods and services, you can see here from this chart that we have seen a significant decline in the household savings ratio here domestically, and a lot of that, when you mirror that with higher inflation, is basically a one-to-one trade-off, and we expect that to be the case continuing going forward. What's problematic, as we see, is that when looking at this data over a 30-year period, you can see that the household savings ratio has now dipped below the average over that period, roughly around about 5%, and we're now, as I said, in the 4-handle territory. So in the context of not only higher and more sticky inflation, higher cash rates coming through the system, the buffer that households actually built up, certainly during COVID, that is really start waning quite significantly and quite quickly. And so that's going to put further pressure on households, certainly if we start to see mortgage rates continue to move higher throughout the second half of this year. So whilst we haven't seen any material stress in the mortgage market. We do believe that that is a potential as we move through the second half of the year, and certainly, as I said, if cash rates continue to move higher, with a terminal rate here locally somewhere in the 4.5 to 4.75 range in our view. So, a challenging market environment was encapsulated in the performance of financial markets throughout May. In terms of our portfolios and our positionings, we've certainly been very cautious in the way that we've been thinking about, shifting both our asset allocation as well as security selection across our portfolios. On the back of higher bond yields, we have continued to add to our fixed income exposures. We're now seeing certainly the long end of the bond curve oscillating around about 4%. So we continue to believe that's an attractive entry point in terms of adding to our fixed income and our duration-based positioning. We've continued to see some widening in credit spreads, so again, have been comfortable slightly adding to that position. We haven't materially changed our equity position and continue to remain relatively neutral on equities, and we have seen throughout the course of the last quarter, certainly, some very strong investment performance coming out of global markets, more so than what we've seen here locally. So from the perspective of, as I said, portfolio and asset allocation, we certainly believe it remains appropriate to, as I said, maintain exposure to growth assets, equities principally. But as I said, we're certainly not significantly overweight across that part of the market. Where we have shifted our allocation and reduced our allocation further has been in that property part of the market, certainly more around the REIT side, both domestically and globally. We feel that the interest rate sensitivity of REITs is quite high to movement, both in bond yields as well as cash rates. And then we've got the double whammy, particularly in sectors like the commercial sector, where office vacancies, are nearing, multi-decade highs on that basis. So the valuations that we're seeing in that part of the market, we think will continue to move lower in the near term. And then throughout our equity portfolios, we've just been conscious of avoiding, consumer discretionary stocks that are quite highly leveraged to the economic environment, and focusing really on some of our key themes around quality industrials, as well as adding some cyclical exposures or continuing to add to our cyclical exposures in some of our longer term themes. So even though we saw copper sell off throughout the course of the month, we see it as a key material as we move forward in the transition to the new economy, certainly around renewables and the like, as well as also adding to our positions around lithium and the diversified miners, where we think are going to be really well placed throughout a recovery cycle. On the China front, I think it is quite interesting to note they're seeing very different challenges to what is happening in the US, for example, around both growth and the inflationary outlook. In the US, we're seeing obviously strong growth numbers continue to come through, led by a relatively a solid labour market, but inflationary pressures continue to abound. In China, it's a weak growth outlook, certainly at this stage of the cycle, and they're really also looking into a deflationary element as opposed to trying to contain inflation. So we do think the weakness that we're seeing in China will require a policy response, both by the PBOC as well as obviously the Chinese government. And as that starts to come through, we think that will be beneficial for commodities broadly, and that will also be beneficial for financial markets, certainly equity markets, on the back of that. So, those types of decisions we think can stabilise what we've seen over more recent periods. But as I said, a really interesting environment for financial markets at this point in the cycle. As I said, we're continuing to focus on both our asset allocation, managing our risk positions, both at, as I said, a sector as well as at a security level. As always, if you have any queries or concerns about the portfolios, please feel free to reach out to anyone in the team, and we'll catch up again next month. Thanks, and bye for now.